Tether just froze about $131 million in USDT, tied to 4 wallets linked by US sanctions to Iran's central bank. No exchange hack, no seed phrase leak. The tokens were still sitting on the blockchain, they simply stopped being movable. At almost the same time, Morgan Stanley updated plans for Ethereum and Solana funds that would stake huge portions of their holdings. Galaxy put up a new institutional bridge into DeFi lending. And the United States Senate found one thing it could apparently agree on: Sam Bankman-Fried should not get a pardon. These look like 4 different stories. They are really one story: who controls crypto when the money gets serious? Start with the freeze, because the mechanism matters more than the headline. On July 14th, the U.S. Treasury's Office of Foreign Assets Control updated its sanctions entry for the Central Bank of Iran. OFAC added 4 more TRON addresses to the entry. Shortly after that action, Tether froze 4 TRON wallets holding a combined total of roughly 131 million USDT, according to the block's reporting. The important distinction is that OFAC listed the addresses, and Tether, the issuer of USDT, used its ability to blacklist them. The blockchain did not reverse the transactions, a miner did not drag the coins backward through time, and some government intern did not open MetaMask and click the giant red confiscate button. USDT is a token issued through a smart contract. Tether controls that contract, and the contract can prevent blacklisted addresses from transferring the tokens, so the balance can remain visible on-chain while becoming effectively immobile. That is why frozen is not automatically the same as seized. A freeze blocks movement. A seizure normally means legal control or possession has actually changed. Those things can become connected later, but they are not the same event, and this exposes the trade-off inside centralized stablecoins. USDT is useful partly because a dollar-like token can travel across public networks 24 hours a day, but it is also useful to governments and law enforcement because the transaction trail is public and the issuer can freeze specific addresses, so stablecoins can look decentralized at the network layer while remaining highly centralized at the asset layer. The road is public. The car still has a remote kill switch. Supporters will call that compliance and argue it is necessary if stablecoins are going to work with banks, payment companies, and governments. Critics will call it censorship and say money is not truly yours if an issuer can make it unspendable. Both sides are describing the same technical reality. The disagreement is whether that control is a safety feature or the entire problem. Now move from issuer control to Wall Street control. Morgan Stanley filed fresh amendments on July 14th for proposed Ethereum and Solana exchange-traded products. The planned tickers are MSSE for the Ethereum product and MSOL for Solana. The headline is not only that a major bank wants crypto funds, we have been past that stage for a while. The headline is what the funds intend to do with the assets. The Ethereum filing says the trust generally intends to stake between 50 and 80% of its Ether under normal market conditions. The Solana filing says the trust may stake up to 100% of its SOL, while keeping enough liquid for fees, expenses, and normal fund operations. Both filings list an annual sponsor fee of 0.14%. That combination is aggressive, low fee plus staking economics inside a traditional investment wrapper. But let us kill the premature victory lap now. These are filings, they are not proof that the SEC approved the products, and they are not a launch announcement. The filings also contain the reasons this is harder than drawing a green yield arrow next to an ETH logo. Staked assets can face slashing risk if a validator misbehaves. Unstaking can take time. A fund needs liquid assets for creations, redemptions, fees, and expenses. Staking rewards can change. Tax treatment matters. Custody matters. And a reward rate does not protect investors if the underlying asset falls. Morgan Stanley names BNY and Coinbase custody as custodians and describes using third-party staking providers. That creates a chain of responsibility: fund, custodian, staking provider, validator, protocol. The wrapper makes buying easier. It does not delete the machinery underneath. Still, the filing tells us exactly where competition is going. A plain fund that only tracks the price may look incomplete when a rival can offer price exposure plus a share of the network's native staking economics. Wall Street is not merely buying crypto anymore, it is trying to package the cash flow logic of the network, and Galaxy's new product pushes the same idea from staking into lending. Galaxy announced a program called GOFR, the Galaxy On-Chain Financing Rate. It is built for institutions, high net worth individuals, and accredited investors. The minimum loan is $1 million, so this is not exactly a found $12 in my wallet time to become a market maker product. Galaxy says GOFR blends variable financing rates from on-chain lending systems including Aave, Morpho, Spark, and Camino, but the client faces Galaxy as the counterparty rather than directly managing a collection of DeFi positions. Galaxy also says it will commit up to $100 million of its own capital as first loss protection, subject to the product's actual terms and conditions. That structure is the important part. Institutions may want on-chain rates, but many do not want 5 browser tabs, governance token drama, smart contract integrations, and somebody in risk management asking why the Treasury team is signing transactions at 2 in the morning. So the intermediary returns. The protocols generate the market. Galaxy packages access, manages the relationship, and becomes the name the client faces. Crypto spent years saying it would remove financial middlemen. The institutional version may instead use blockchains underneath and put a very familiar middleman back on top. That is not automatically bad. A clear counterparty can simplify risk, reporting operations, and legal accountability. But it does mean the final product can look less like permissionless DeFi and more like traditional finance using DeFi as a back-end. Now for today's political plot twist, the Senate reportedly agreed by unanimous consent to a resolution opposing any clemency for the former FTX chief. Senate Resolution 772 says the former FTX chief should receive no pardon, commutation, or other form of federal clemency. The resolution was introduced by Senators Ruben Gallego and Cynthia Lummis, and it points back to the scale of the FTX fraud and Bankman-Fried's 25-year sentence. One legal detail matters. This resolution is non-binding. It does not erase the president's constitutional pardon power. It cannot lock a pardon button inside a titanium vault and throw the key into the Potomac. What it does is put the Senate's political position on the record, and unanimous consent is notable because Washington can usually turn agreement over the color of the sky into a 3-week committee fight. The broader message is that crypto's political rehabilitation does not automatically rehabilitate every figure from the last cycle. The industry can gain new rules, new products, and friendlier access while FTX remains the line lawmakers do not want crossed. Now look at the market around all of this. At today's source check, Bitcoin was trading around $64,100, with an intraday range from roughly $63,800 to $64,900. Ethereum was around $1,625, and Solana was around $78. Those figures will move, so the exact on-screen numbers will be refreshed before publication. But the bigger point will not. Crypto prices are still reacting to macro conditions, profit-taking, and geopolitical risk. Meanwhile, the infrastructure around crypto keeps becoming more institutional, more regulated, and more controllable. That creates the central contradiction in today's news. The technology is becoming easier for large pools of capital to use, but every layer that makes it easier can introduce another controller. The stablecoin issuer can freeze. The ETF sponsor decides how much gets staked. The custodian and validator manage the operational chain. The institutional desk decides how DeFi risk is packaged, and lawmakers decide which failures become political symbols. So the real question is not whether crypto is centralized or decentralized, as if one word settles the entire system. Ask a better question: which layer is decentralized, who controls the layer above it, and what can that controller actually do to your money? That answer matters more than the marketing. Nothing here is financial advice. This is today's crypto news, and the signal is simple. Crypto is becoming real financial infrastructure, but real financial infrastructure always comes with a control panel.